Gold is ready to rumble. Gold performed well last week. It traded at $1,769 an ounce on Monday, November 30, and rose to $1,842 an ounce until the Friday closing December the 4th. This is a 4.1% gain, not a bad weekly job. Gold trade is pretty much the same today. Still, this mini rally should be viewed in the context of the steep roll that preceded it. Gold fell from an intermediate peak of $1,951 an ounce on November the 6th to $1,769 an ounce on November 30, a 9.3% drop in just 3 weeks. This rapid drop was the last leg of the midterm drop from $2,063 an ounce on August 26, 2020. Gold fell 14.3% in 3 months from an all-time high. The decline since August and the decline in the last November varies gold investors. Is the bull market over? Is gold going down to $1,200 to $1,400 per ounce, which it held from early 2016 to mid-2019? Here is your correspondent, about 700 feet underground in a gold mine in Utah. Before descending, we were kitted out with helmets, headlamps, reflecting vests, and miner's belts with an emergency oxygen supply attached to the belt. This mine is still in the development phase, not yet in the production phase. This means that different safety standards apply, including the fact that there was only one elevator shaft. If the elevator malfunctioned for any reason, the only alternative exit was to climb a 700-foot fixed ladder. Fortunately, events went smoothly. This kind of hands-on experience in the mine is critical to understanding the entire gold supply chain from mine to refinery to bullion vault. More importantly, investors want to know if last week's return is a sign of things to come or a glitch in a long-term downtrend. Short answers: the bull market is not over. Gold is not on its way back to $1,400, and gold is now continue to skyrocket upside down to $2,000 an ounce and above. Gold investors understand what happened. They may not understand why. An explanation of the reasons behind the recent drop in gold prices will explain why last week's rally was real and why there are all-time highs on the cards. There have been 4 factors contributing to the decline since August. The first and most powerful factor is the rise in interest rates. It's no secret that gold has no returns and competes with cash and treasury bills for allocations from investor portfolios. 10-year treasury bond yield to maturity dropped to 0.508% on 4 August 2020, about 3 weeks before gold peaked. The odds rose steadily from there. As late as September 29, the 10-year rating rate was only 0.654%. Then it rose to 0.970% on December the 4th. The rate increase created capital losses for shareholders but caused a flood of capital from new buyers. Part of the capital carried the treasury bills came at the expense of gold. The second factor is choice. The consensus was that Biden will become president and the Republicans would control the Senate. This meant huge new spending bills were on the way, but the worst excesses of the progressive wing of the Democratic Party will be thrown aside. This scenario is nirvana for the stock market. The appeal of gold as a safe haven waned, with large spending approaching and the policy of extremism getting stuck. The third factor is the approval of several COVID vaccines and new therapeutics. These developments supported the view that the pandemic would soon fall behind. A combination of business reopening and pent-up demand will quickly restore strong growth and reduce unemployment. A strong economy predicts higher interest rates, which is unfavorable for gold prices. Also, the investor proposes higher stock prices, another competitor for their dollar. Economic happy talk is one more reason to move away from gold. The fourth factor includes technical and market dynamics. The price of gold is not really the price of physical gold, given the scarcity and high commissions associated with gold supply today. Instead, the price you hear is actually the COMEX futures price. This is a highly leveraged paper gold proxy for real gold. Futures trading is automated and based on algorithms that mimic other algorithms. The result is that when prices fall, more sell orders are triggered, momentum increases, stop-loss levels are reached, leveraged players compensate their losses. In a recursive dynamic that surpasses baseline valuation based on money supply or economic prediction, analytical. This is how automated markets work today. These gold market dynamics show that the wins for the gold price continue. What is the counter-argument for the increase in the dollar price of gold? Currently, my models tell me that the dollar price of gold has risen significantly. Last week's price action was not an anomaly in the downtrend. This was the definitive beginning of a great new rise. Interest rates, politics, economic forecasts, and automated trading combined to trigger a decline in the dollar price of gold, and then accelerate that fall to the level we have seen recently. Here's the good news. None of these factors are sustainable. All will soon reverse and send the gold prices back to the $2,000 ounce level. Here's the reason. 10-year Treasury bill rates have fluctuated, showing an overall downward trend over the past decade. Rates reached 3.6% in February 2011, then dropped to 1.38% in May 2012. Rates rose back to 2.87% in December 2013, then dropped back to 1.28% in July 2016. Another increase sent the rates to 3.1% in October 2018, followed by another drop to 0.5% in August 2020. What bounces off the data is that after every increase in rates comes a crash, and each slump recedes lower rates than the previous drop, 1.38%, 1.28%, and 0.5%. The reason is clear. Every time the market raises rates based on some explanation for inflation, growth, or the reality of the end of the bond bubble, a weak economy grows weaker and rates begin to fall again. The market gets the narrative wrong every time, but keeps trying. The bond confuses nominal interest rates, which are low, with real rates, still relatively high. These high real rates hinder growth. The durability of gold against these periodic increases in rates is shown in chart 1 below. This chart shows the dollar price of gold as both the daily closing price and a simple moving average from year to date. We are in a new Great Depression. The negative effects will be between generations. Most of the small businesses that shut down will never reopen. Bankruptcies are rising rapidly. Job losses will be permanent. The disease is still getting worse. New deadlocks will cause a new recession. Again, the stock market priced a recovery based on upper-weighted indices supporting relatively few businesses, generating technology companies. The real economy of small and medium-sized businesses, about 45% of GDP and 50% of all jobs, lies on its back. This will manifest in terms of higher saving rates, reduced consumption, and reduced labor force participation. Finally, momentum is a two-way street. The same forces that caused the gold market to overrun will cause the next rally of gold to go up. He starts buying, leveraged shorts rush to cover, and rowboats buy out of fear of being left behind. Since August, gold has faced winds of higher rates, political trends, rosy economic scenarios, and a leveraged momentum. These winds are about to turn into backwinds as the economy slows down, rates fall, political uncertainty grows, and the momentum is heating up. Conscious investors will buy gold at the current bottom. From there, they can enjoy getting back to $2,000. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.